All right, good evening, class. It's kind of late here. We're here to talk about the importance of conducting a sensitivity analysis and how it's a key tool for capital budgeting. The link will be uploaded later for you to check it out on YouTube. All right, first, what is a sensitivity analysis? A sensitivity analysis is a vital tool in capital budgeting. It helps us understand how sensitive projects net present value, or NPV, or even the internal rate of return, is to changes in assumptions like costs, revenues, or discounts. It connects finance skills to real world managerial choices, helping you assess if a project holds up under pressure, right? We really need to know if the juice is worth the squeeze on this. That's kind of what sensitivity analysis lets us understand. So it helps us balance risk to make better decisions, weigh possible scenarios, to build confidence in stakeholders. Stakeholders are all about managing risk. So it helps give them more confidence and manage risk in their decisions. Um, so capital projects involve uncertain market conditions, costs, the shift of demand. A sensitivity analysis also lets us test the what if scenarios and making sure that we're prepared for surprises. It builds confidence by showing stakeholders we've stress tested our assumptions. And qualitatively, we need to identify key drivers, right, that shape our project. We then need to prioritize these drivers to see which ones we can rely on for the most, rely on the value, rely on value for most. The key is to engage teams, finance, operations, strategy, and this gives us real world insights. Then we take these scenarios and then do a base case, an upside, and a downside to mirror corporate challenges. This sets up our numbers. Quantitative steps are next. All right, so here's the numbers. We first need to build a base model or foundation, working with the NPV calculation using expected cash flows based on our project. Then we've got to tweak one variable at a time to make sure that we get the exact amount. You don't want to do more than one because then we don't know which one's going to change, right? We got to make sure that we know which one's affecting our numbers. So we do one at a time. So maybe sales drop 10%. Then we got to recalculate. And then we track how much the output changes, spotting the most sensitive inputs. So if you look to the right, you'll see a tornado chart. Graphs like the tornado chart make results easier to read because you can kind of visualize which variable changed the most between each test. All right, so incorporating risk into capital budgeting. A sensitivity analysis shows us which variables, like raw material costs, could raw material costs or other costs, how they could derail a project. We can discount the rate to reflect risk, test extreme scenarios, and test rules. If the NPV goes negative in a really realistic case, we rethink. We also need to plan backups to manage and or mitigate risks to show positive outputs for our stakeholders. And for tools, Excel works well. We can use tables or other analytic tools. Python's great. Power BI is also great. There's a couple other ones out there that are kind of up in the world. But I think Excel and Power BI are crushing it in the market right now. Stick to best practices. So limit your variables between 3 to 5 key drivers and use market-based ranges and always align with the company strategy. Don't overcomplicate it or skip the qualitative side and never ignore the competition. All are crucial for solid results. Here are my references. So we got Brigham and I think it's Arnhart or Earhart. Earhart's Financial Management and Ross's Corporate Finance cover the concepts in depth. Excuse me. These cover the concepts in depth. Thank you for listening on how to use sensitivity analysis to make smarter investment decisions. And have a great evening. I hope I get 1 million views and I become famous overnight. Thank you.